Hello and welcome to CMC Markets on Tuesday the 9th of September and the weekly market update, and this will be my last weekly update for a couple of weeks, back on the 30th of September, and I don't think there's any prizes for guessing what I'm going to be looking at this week given the events of the weekend. Really it's about the pound and it's about the Scottish referendum, and I don't think that investors had really factored in the probability that we might well get a yes vote. I think there had been a significant amount of complacency about that, and that's certainly been reflected in the price action in the pound in particular, as well as obviously stocks that are particularly exposed to the Scottish economy over the past few days. So for the purposes of this particular video, I'm going to be looking at the pound against the dollar, looking at where the next key levels are in the context of the decline that we've seen in the pound over the past few days, and where we're likely to go to next. So let's start with the pound against the dollar, and as we can see from this daily chart, we've had a pretty precipitous decline from the highs that we saw in July at 171.92. Now, we closed in New York on Friday at 163.25. Then obviously that YouGov poll came out at the weekend, and lo and behold, we gapped right through the 38.2% retracement from 162.80 of the move from the 148.15 lows that we saw last year to the highs that we saw this year. So that 162.80, there's a massive gap there. Any pullbacks in the pound are likely to find that a very significantly difficult barrier to break through. So really it's a question of where do we go to next, because I certainly think the direction of travel now and the technical damage to the pound is so great that there's significant potential for us to test the 160 level. And the 160 level is particularly important because it's 50% retracement of that previous move that I outlined before. So 160.05 is a 50% retracement of the 148.10.15 up move to the highs at 171.92. 160 is also very important in the context of this weekly candle chart that I'm about to show you right now. Now, as you can see, I've put the retracements on in the same way that I have for the daily chart. We can see on the weekly chart that the market is incredibly oversold, but as you can see from the daily chart, that doesn't mean that it can't go any lower. But what's important about the 160 level is it's also the 200-week moving average. So we've got the 200-week moving average, we've got the 50% retracement level coming in at that level. If we break through 160, then we could well go an awful lot lower to around about 157.80, or 157.20 rather, which is the 61.8 Fibonacci retracement level of the same move that I talked about earlier. So while we've seen a significant move lower in the pound, it's not just been about sterling weakness, it's also been about US dollar strength, particularly where the cable is concerned, because we haven't seen a significantly big decline in the pound against the euro. And this is borne out in this daily chart that I've got in front of you right now. Now, we've got a significant resistance level around those August peaks and September peaks at 80.35.40. That's a significant resistance level. We can see that from the horizontal line that I've drawn through the highs. If we then draw a horizontal line through the lows, we've potentially got a double bottom here, a potential double bottom, but we've only got the double bottom in the event we break above 80.40. So to project a price target in the event of a breakout, we simply add 150 points to 80.40.50, which basically brings us out around about 82. So we break above 80.50, then we could well get a potential move to 82. And that's one particular point that we really do need to keep an eye on, because essentially, given what Mr. Draghi outlined last week, and also the fact that the likelihood is we're probably not going to see an interest rate hike here in the UK this year, there's going to be significant push-pull on the euro sterling with respect to further easing on the side of the euro and political risk on the side of the pound. So at the moment it looks like a range trade until such times as we break out either on the resistance on the top side or the support on the downside. I'm quickly going to finish up with the dollar yen, simply on the basis of the dollar strength story and potentially further yen weakness. We've just broken above a very key level on the dollar yen at 105.70. That was a 61.8 Fibonacci retracement level from the highs in 2007 to the lows in 2011. Now that we've broken significantly above that, we pretty much can look at penciling in a potential move over the course of the next few months to around about the 110 level. I don't think, looking at the weekly chart that I've got in front of you right now, there are no real barriers to that, and unless we drop below 105.20, then I think there's a very good probability we could well see 110 in dollar yen over the course of the next few weeks and months. So that pretty much sums up this week's weekly market update. Thanks very much for watching and listening, and I will see you all again on Tuesday the 30th of September. Until then, have a good week.